finance in a way was stuck in the pre-digital age. If we're right with this bet on basically on-chain financial products being superior to off-chain financial products, then you will see most assets on-chain in one way or another.
I've worked in kind of Web 2 for a long time, first starting in consumer, then more and more towards like enterprise software and fintech. So I had a bit of experience working with very large corporates and large financial institutions, and just kind of saw like from the inside what their tech stack is. Already in 2015-16, we were thinking about, okay, how could we use blockchains to solve some of these problems? I think for me, it really clicked when kind of the idea of Ethereum with programmable smart contracts came out and kind of really showed, okay, like you can program and actually create code. Like really for me, it was this, okay, like you can program logic, because that's something like programming money is something you can't do with traditional software. And so that was like, okay, that makes a lot of sense. And then in 2017, we kind of started Centrifuge as a project. That was way too early. We still spent a couple of years kind of really building at the very core. Like DeFi wasn't really a thing yet. Like stable coins were not really popular. It was very hard to kind of do these first couple of transactions. We went then live with the product kind of that we have now in 2020. Centrifuge allows asset managers, financial institutions to create financial products using blockchains. So instead of having to rely on paper contracts, on like manual accounting, transaction settlement, etc., these asset managers can now issue tokens. As investors, you can hold these tokens and you benefit from kind of all these efficiency gains, like ease of use, increased transparency, etc. Like the traditional transaction is like you sign a contract that says, I sell you this fund share, you subscribe to a certain fund through your brokerage, right? There's usually like, depending on which asset class, but it can take days, 2 weeks to actually settle these transactions. So it takes time to send the paperwork around, check it on both sides, settle the transaction by making sure the money is wired, then the accounting to get updated, right? And so there's a lot of manual steps here that like really are not necessary when you think of like, you have a token, you transfer it, and the trade is immediately executed, right? So this is like one of the benefits. Another benefit is like when you think of a real estate fund, for example, right? You have potentially thousands of properties that all have, for example, rental income. That rental income, then there's fees deducted out of it. Then from that, an investor would get like a monthly payment. So there's just a lot of calculations that need to happen that we really need to make sure they're correct, that everyone wants to see how they're being done and audited, right? And so like you can actually use smart contracts to kind of manage where this money flows, and instead of what today a lot of time is just simply very clumsy spreadsheets that have more mistakes than you think, that then are often costly and take forever to catch, right? Like you can kind of rely on smart contracts to settle these kind of things. So you get a lot of benefits when you ultimately like programmatically create these financial products, as opposed to like relying on a lot of human labor. So from there, it really kind of started evolving and growing much more quickly, where we had to create the category like real world assets. When you think of like what you had first just Bitcoin, then you started to have like some stable coins, and you had this and like Ethereum and other tokens, and you had DeFi where like people started building lending, borrowing, trading products, and then kind of what we did is we said, okay, like now we have this infrastructure, this core financial system of these primitives that we need to now actually make this usable for real off-chain products, right? And so that's how we came up with the idea of using this DeFi technology for real world assets. We work with so many of the largest DeFi protocols and DAOs to actually really bring these products forward. We've created standards for how investors can invest and kind of redeem and manage their holdings of these assets. now every major bank, every major financial institution has a strategy of how they're going to start using this stuff. Earlier this year, even BlackRock, the largest asset manager in the world, actually are releasing their first real-world asset, their token, which gives you yield on treasury bills. When you deal with these real-world assets, it's a lot of times both legal and technical solutions, and so we've done both a lot of work on both sides to a point where, now as a financial institution, you can come to Centrifuge relatively quickly, like within weeks, launch your product and start distributing it to users that you want to distribute it to. And so we're seeing more and more asset managers actually kind of looking at that, at the tech and starting to work with us and launch products. We're at we have, I think, close to 600 million in origination. So that's kind of investors coming in and going out and like assets being purchased. And we're at about 300 million in total value on the platform today. So it's so just outstanding assets on the platform users are holding is about 300 million. Mostly treasury bills, real estate, trade finance, consumer credit. Yeah. So the main product is the fund management product. It's really what these asset managers, financial institutions are using to kind of issue these tokens on chain. It is taking combining the legal structure, the accounting, the kind of portfolio construction, and creating then a token that if I own it, I have an ownership in the underlying assets. And so Prime is the offering where like DAOs can come and say, okay, we'd like to start buying more of these products, like help us figure out how we take care of the legal, how we construct this portfolio. Most of crypto is so correlated with the price of Bitcoin that like if you don't really diversify away from it, your treasury is gonna go up and down with the price of Bitcoin. But most of your salaries, right, you're typically paying them in dollars, euros, whatever. So if you own crypto, you want to start having dollars and make income on those dollars, so you know that like no matter what the market does, you're not going to suddenly get into trouble with not being able to pay salaries because the price of Bitcoin is crashing and everything is tanking along with it. We're saying, well, a lot of these DAOs want to diversify away from crypto and not just hold highly volatile, right, like assets where they're totally exposed, but like maybe have some US dollar stable assets that generate some return. So what they don't have is they oftentimes don't have the investment experience, they don't have the legal structures. And so actually since 2020, 21, we worked with MakerDAO on really having Maker buy some of these assets. We're now working with Gnosis and then with a couple others to kind of help them. For a crypto native person, like for me also, even myself, right? Like if I don't have to go off chain, send my money to an exchange, then to a bank, and then like buy these products in Robinhood or whatever else, right? But instead I can just do it on chain, and it means that I save myself all these hops. And if I want to go back into buying some crypto asset, right, then I can very simply do this. Actually, Web3 Foundation has, instead of holding treasury bills directly, have started investing in a pool on Centrifuge. That was actually, we did that a couple of months ago. I think the Polkadot DAO right now has $8 million of stablecoins, if I'm correct. So the discussion that's going on is, okay, should some of it be put into treasury bills on Centrifuge so that you start earning currently 5% yield on it, right? So yeah. If I want to invest in a real world asset, it's no different to investing in a traditional asset. Some assets are very liquid, right? Like a treasury bill fund, you can get in and out on a daily basis because like there's so much liquidity for these assets. Maybe if you invest in a venture capital fund, usually your money's locked up 5 to 10 years. You can't just, when you want out, sell an illiquid startup equity. You have to wait until the fund winds down and those companies have sold or IPO'd or whatever, right? So that really doesn't change. I think the difference though is the way that you do this is fully automated. I mean, one of our oldest pools is a short-term real estate fund. There's typically liquidity every couple of weeks. So 1 or 2 loans are being originated. So like if you want to put in more money, you just put in more money. You don't have to really interact with anyone. You can just go to the app, right, and say, okay, I'd like to buy 10,000 more of this. I'd like to redeem 10,000 of this. And so that part is automated. Say I own tokenized treasury bills on chain. I want to sell them immediately on a Sunday afternoon, like some other investors, I'll buy these. I have some cash. I want to buy some treasuries, right? And kind of making that happen completely, trading and settling on a blockchain. Well, the technology can't magically double your returns. The thing that the technology can do, though, is reduce fees, right? So fees in some of these credit products are starting at maybe 0.25%, but it can go anywhere up to like 1.5%, 2% on like exotic private credit stuff. These fees are coming from 10 different service providers to auditors to valuation agents, right? And all of these different companies that are working together to kind of build that fund. Now, if you can replace more and more of these service providers with software, because what they're doing a lot of times can actually be automated, now you're actually starting to reduce these fees. So you'll have slightly higher returns, and it's significant, right? Like when you make 5, 7, 10% of interest, 0.5% in fees less is actually, that's a 5% increase, or maybe a 10% increase depending on your returns. The other part, though, that is really nice about it is that like tokens are just easier to deal with, right? So it's actually very hard for a bank today to give you a loan against some fund shares. Like usually you can do it with stocks in your brokerage account, but typically those transactions have to be really big for a bank to say, okay, I know you have these assets and we're going to give you a loan. But if you have a token, like it's very easy to know, okay, you actually own the assets. No one else has them because you have the tokens. It's very easy to just transfer them and lock them up in some escrow account so that you can borrow against it, right? So one of the things that is happening is, well, borrowing against it gets cheaper. Likewise with secondary markets, like the New York Stock Exchange, NASDAQ, whatever, right? Like they are relatively liquid. They work very well. It's digital, fully digital. But if you look at most asset classes, they're not traded on a fully digital trading system like the equity market. So actually, when you start looking at the very long tail, like the majority of assets, like it's very hard to trade them. A lot of times it is because, it's hard to create liquidity for them, but there's also a lot of infrastructure cost to create a market, because how the New York Stock Exchange is structured, it's not cheap for them to list assets. It's not cheap for them to run it. They have a lot of like legacy and kind of infrastructure that if you start replacing that with DEX, right, then actually like you can create better liquidity, and that makes these assets more attractive, because if you can sell the asset, then it's much more valuable to you than, right, if you're forced to hold it for a certain period of time. So those benefits actually are what makes kind of real world assets so exciting. We focus on credit products, so debt and other assets, right? There's also the equities market and commodities. Let's just focus on debt for now. Let's think of a bond ETF or a real estate investment fund or trust. Those, right, it's usually a set of assets. There's a set of investors. There's certain rules around which assets are being bought. There's certain rules around how interest is being paid out. There's a prospectus that the asset manager writes and explains what the product is, how they manage the risk, how they manage choosing these assets, right? So when you do that today, a lot of that is just done in legal contracts. If it's a public product, you go to an exchange and you try to list that. That's a huge effort. If it's a private fund, you'll go and raise money from family offices or whatever. Now, what's in the end, right? Like that process largely is still the same, but instead of defining how the assets are being valued and then how profits are being calculated and how investors are being paid out in kind of legal contracts, you set up a pool on Centrifuge, you put this logic in, so the asset manager kind of creates that, and then instead of like you starting to collect investment documents and and checks or wire transfers, right? Investors can come in and just use the application to kind of say, okay, I want to subscribe to $100,000 of this fund, but instead of sending dollars, right, they put in stable coins. Those stable coins go into the pool, and now that's available for the asset manager to start kind of running this pool. And then when vice versa, when like money comes back, right, like the software then calculates what everyone gets. If you want to transfer an investment to another person, this is really just a token transfer. You can do it at any time of the day and kind of in seconds, right? And then kind of for us, the big next step is to bring secondary liquidity. It's like, okay, how do you not just have tokens that you can hold and just wait and kind of earn interest on or profit on these investments? Now, how do we allow users to trade them on secondary markets, to borrow against them, to kind of create derivative structures, right? And so actually a big work we've done is work with different lending protocols so that if you have one of these pool tokens, you can actually go and just borrow money against it. I mean, in a simple example is like you have your house, you want to install a new kitchen. You don't want to sell the house, but you need some money. You go to bank and say, oh, I need a loan. Here's the house as collateral, $50,000. I'm going to do this remodel. Similarly, when you have, say, Apple stock, you don't want to sell the Apple stock because you think it's still going to go up, but you have like maybe short-term cash needs. You want to use the Apple stock and as collateral and borrow money against it. And so you can do those kind of things with DeFi protocols. And so that's something that I think as an industry we'll see happening over the next, I would say, 6 to 12 months. So sometime my bet is sometime in 2025, we'll see kind of first real secondary liquidity for these tokens, which is going to be very, very exciting to see. So we started in 2017 experimenting on Ethereum. We always knew that like mainnet Ethereum wasn't going to be the place where we can scale. At times we spent probably like $250,000, $500,000 on gas dollars. So like it was very expensive. We wanted something that was very scalable and secure, but we also knew kind of early on that you're not going to convince users that easily to migrate from one chain to another. So we said, okay, well, like we need to find a way that we can do a lot of the heavy computation in a place where it's cheap, but then still allow users to interact where they are. A lot of users, investors, right, that hold these tokens, they are on all sorts of different networks, many different blockchains. They can invest kind of and hold these tokens natively where they are. But then we actually use a combination of different bridging and messaging protocols to have most of the heavy lifting, the computation really happen on our parachain. So all of these processes of having the asset managers create the portfolio, value it, calculate fees, etc. This kind of work that's done by a handful of these different pools, right? That happens on our parachain, which really has the scale and the functionality that we need to then like basically allow these investors across different chains own different tokens. Like we have many investors on one side that buy financial products, and we have a handful of issuers that create these products. The issuance process, that's the really heavy lifting, where you put in a lot of data, there's a lot of calculations being done. An investor is putting in USDC and then accruing interest and holding these tokens. That's relatively simple. So the architecture we have now actually is we have what we call liquidity pools. So those are deployed on different networks, a way for investors to hold these tokens, invest, redeem, and natively on I think it's now started with Ethereum, then Polkadot, Base, Arbitrum. So that's kind of the investor side. And then on the issuer side, these different steps of really going from this is the asset to how much was the fees, how much was accrued in value to like how much should the investors get, right? Like those calculations, or that's being done on Centrifuge chain, the parachain, where like really the most of the computation intensive stuff is happening. That really makes it easy for users to onboard to Centrifuge because we can meet them where they are with kind of a very low fee and scalable solution. And there's like quite nifty messaging and kind of bridging work that we do to make sure that this portfolio that's being constructed on the parachain is then really what the token holders hold across like the different networks. We use, for now, mostly Axelar as a messaging protocol, but it's not that we send tokens across. We send information about the portfolio in a summarized way to like the different networks, and through that can be much more efficient but also safer. The next iteration is going to have us kind of use a combination of different messaging protocols. So like possibly add like a chain link, for example, or another bridge to kind of then add more redundance to kind of how the network is linked. We were looking at a lot of the different bridges. Ultimately, Hyperbridge, Snowfork, Axelar, I think those are all like Chainlink. Some of the Oracle protocols are kind of becoming bridges as well. So that's, yeah, so we're looking at those. When a lot of the multi-chain projects today, their strategy is just to fork everything and deploy it again. So with that, you don't really get efficiencies of scale because you just replicate. Oftentimes you fragment stuff, and that has kind of downsides. So we wanted to not do that, because we could have just said, we have this in Polkadot, we have this in Ethereum, they're two different systems, they don't really talk to each other, and like if you want to talk to users on both, right, you do the work twice. And that ultimately creates fragmentation, a lot of overhead, and we didn't really want that. We wanted to just say, like, we want to have this kind of central piece, the parachain, that does this heavy lifting, and then the rest of it is kind of really just the user interface maybe to that, in a way to what's happening. Ultimately, real-world assets don't work without a legal structure. You do rely on some courts and say you invest in a real estate fund that owns a house, like that house, if it ever gets foreclosed on, that you get the money. So we've always had to think of, okay, which jurisdictions can we do this stuff in, because they have rules that actually allow us to do these things on chain. A lot of countries wouldn't allow you to actually issue a financial product in any other form other than in a very clear, like, legal paper contract, and you can't do it with a token. We have a good in-house general counsel that's been really valuable in this, in kind of driving this forward, and a lot of times, like, innovating on the product means as much like innovating on the legal structure as it means like figuring out a technical solution. And so we have a set of law firms that we work with in kind of different jurisdictions. We've also built a network of people that share knowledge, right? Like, I think ultimately today it's still trying to figure out what works. 5 years from now, I think there will be a few structures of how everyone does it, and no one thinks about it. Like, we'll just, okay, well, like, you want to tokenize a product, like, this is how you do it. I think that's also something we need to work towards. What I would say about crypto, it's incredibly exciting because of like how much it's been a paradigm shift in what's possible and how software is being built with crypto. I think that's very interesting. And it opens up a lot of things that you can't really even imagine. For us, like, what was really important is we iterated a lot, right? Like the first version kind of pilot we did in 2019. Then we launched with a live product in 2020, and we were live on Maker in 21. So there were always these like milestones. We try to really, it's hard to kind of have an agile approach in crypto because security is really important, and releasing software on a frequent basis is not that simple. So, but you should still try to find out what's the simplest product you can build that you can quickly launch and get to market, as opposed to, and we've seen this in like 2017 ICO projects that then spent 2 years spending all of their money on building a big thing in a lab, never getting any users, and then releasing it and nothing happened, right? And so I think it's a bit of it's tempting to try to do that and overcomplicate things, and I think, yeah, you really should try to avoid it and really get like a first working product out as soon as possible, and like simplify it and try to see, okay, like, what is the core that we need to build. When we started Centrifuge, our very strong belief was that a lot of the financial system will be replaced by DeFi by blockchains. If you look at it today, right, vast majority is that, because programming money is such a hard thing to do otherwise. And there's many other places as well where you have huge benefits from using blockchains and decentralization. I think like creation of registries, right, like naming systems, or a domain name system, right, or a social media where you have your brands and names and ownership. In that way, gaming as well, right, where like you have you can use a blockchain to have ownership over game assets and kind of make those useful beyond a single game or single world. I think when you look at blockchain and what it allows you to do, I think there's a lot of exciting stuff. I mean, maybe the big unsolved problem that I would talk about in crypto today for me is still privacy. We have some of the necessary fundamental cryptography to solve it, but it will require a shift in how this stuff is being developed. A lot of times you don't, if suddenly the majority of your life was on chain, I don't think you'd be comfortable if that was all public and linked to your identity. So I think that's something we have to solve. I mean, imagine like your entire checking account was publicly visible. Everyone knew what you're paying in rent, how much your health insurance costs. You'll have like no privacy anymore. Everyone will know what products you're buying. So right, like those kind of things doesn't work. So I think like that there are a lot of use cases that we need to get privacy for. Also in like the B2B world, right? Like secondary markets, a lot of times you want private bidding so that you can't. If you know that I'm bidding $100, you're not going to bid $150. You're going to bid $101. Having some privacy around who's bidding, how they're bidding, right? Like is actually quite important. And so that is, I think, maybe another piece where we can improve on what's being done today in crypto. That I personally think is going to be very necessary for really global adoption to be reached.